Number fourth one, we have historical cost concept. It holds that cost is the appropriate basis for initial accounting recognition of all asset acquisition, expenses incurred, service render, and so on. It also holds that cost value are retained throughout the accounting process. To lay emphasis on this, historical cost, we can call this an initial cost. That before you can recognize any items, you recognize it based on cost, and cost is the way that we recognize the asset. Like if you want to purchase a fixed asset like motor van, the initial cost which you used to buy that asset must what you must put into consideration when you are preparing a financial statement. Then incur expenses incurred like wages, salaries, electricity, and the likes is also part of something that you must take into recognition when you are preparing profit and loss account and service render. So that is what you will retain. You know, when you are preparing a bank statement, which is a balance sheet, the first thing on the asset claim side, when you are to make a depreciation for the asset, after you must have written the asset, then on the other side we have cost, we have depreciation and the net value. So cost is the initial appropriate recognition of any asset. That is that for it. Then we have a materiality. Materiality concept holds that only items of material value are accorded their strict accounting treatment. What are we talking about under materiality is that the items and items which has material value. For example, now there are some items that they are 50 naira, 2 million in value, that their inclusion in the financial statement will always distort a financial statement. So those items that has material value, then accounting must take cognizance to that. That's why it was that only items of material value are accorded to. That means you must include them in the financial statement. Now we'll be talking about dual concept. The application of duality concept therefore ensures that all aspects of transaction are accounted for in the financial statement. That is, all transactions must have dual effect, debit effect and credit effect, and that brings us to double entry principles. I told you the other time, which I lay emphasis the other time, that the dual concept is that when you have a debit side, you must have a credit side. So it ensures that accountant, when preparing financial statements, if you prepare one account and did not prepare that items twice, is not complying with dual concept. So we have it that in every corresponding credit basis there must be corresponding credit entry. So it ensures accountant to apply double entry principles when preparing financial statement. Then money measure. Money measure, this concept holds that all transactions are events recorded in the financial statement must be reduced to unit of monetary currency. You know, as an accountant deals with figures a lot, and what they record is must something that you must measure it with what? With money. Must have a money value. That this is like, for example, you bought a goods. That means there must be a money measure for that good. Maybe 20 naira. It is that 20 naira you record in the accounting record. So every item that a transaction that you enter into must have a money that it must be accorded or measured for it. That is what we call money measurement. So every accountant when preparing, they must apportion money to a particular group in order to give them when they are preparing financial statement. Likewise, we have a realization concept. This concept establishes that the rules for the recognition of revenue as soon as one, how you can realize your revenue is number one, it is capable of objective measurement. before you can, the recognition of revenue is that it must be capable of objective measurement. Then the second one is that the value of the asset received or receivable is in exchange is reasonable certain. Then the next one is it is possible to recognize revenue at a variety of points where, e.g., when goods are produced. That means you can realize, you can accord, you can make a provision, or you can prepare an accounting when goods are produced. Let me lay emphasis on when goods are produced. You know, when goods are produced, you must have realized the revenue that you are going to get from that money. So with that, you can easily get the revenue that will come in for you. Then the second one is when goods are delivered. At the point of delivering goods to the customer, like you deliver 50,000 worth of goods, immediately you deliver it, you could have known that 50,000 will come as a revenue for you. Or when the transaction is completed. So at the point that you can recognize revenue under realization concept is when goods are produced, then when goods are delivered, and when transaction is complete. That are the 3 points where you can realize your money. So that is the under realization concept. I'm talking about the theme theory, which is the journal and cash account. What is general journal? General journal is a book of entry into which transactions are entered on the daily basis and then classified into debit and credit and then posted to the ledger. It can also refer to as journal proper and does not form part of the double entry. When we're talking about general journal is the book that you use to enter any transaction, maybe items from maybe you purchase an account, which is also a transaction. So you can post a general, you can post it into general. It fits into any type of account. What are the uses of general journal? What are the things? What are the important? What are the reasons? Why do we use it? Is number one, it is used for recording of disposal of fixed assets. When we're talking about fixed assets, we're talking about building, land and building, furniture and fitting. We have a motor van and so on. So you can post any fixed asset into journal. So journal fits into any fixed asset. Second one, we have correction of errors. You can use journal also to correct errors, to make a necessary adjustment when error occur in an account. Then the third one is double entry transaction. Journal is also used to make a double entry transaction because it is a kind of account whereby, you know, when we are talking about debit entry transaction, we are talking about how to comply, how we could be able to comply with a double entry, which must have twofold account. We have debit side and the credit side. So likewise, general journal, though it does not form part of double entry, but you can use it to record any double entry transaction because it has the debit side and also has the credit side. The fourth one, we use a general transaction for recording opening entries. And when we are talking about this open entry, we are talking about how to prepare our trial balance, whereby we have debit, credit and credit side. So we post it to the side where they belong to. So we use general journal for recording of opening entry. Then the fifth one is transfer of items between accounts. You can transfer any items, any transaction from between one or two accounts. So that is another important uses of general journal. Then the last one is for recording closing balance entry. You can also use journal to record closing balance entry. What are the layout of a general journal? I'm talking about the format that we use. That anytime you see this kind of format, you could have denote that it is a general journal. We can call it layout or we can call it format. So these are the format. Under the format, we have a date where the transaction that you make in a particular year, you put into the date where it fits into. Then we have a particulars, which talk about the account to be debited and account to be credited. And we also have a folio. Folio is where you generate that account. And we also have debit and credit side. And there's something spectacular about general journal is it has a narration side whereby you say account being debited or errors being adjusted. You just give them a brief narration on how you present, how you enter those items. What now? The uses of journals. We talk about use of journals for recording of disposal, correction of errors, double entry transactions, for recording open entries, transfer of items between accounts, and recording of criminal. So we'll be making an illustration with the uses of general journal, and we will talk about corrections of errors and